Stop. Don't scroll. Don't sip that coffee. Don't answer that message. Close the door, put the phone face down, and give me your full attention. Because what I'm about to lay out is not another silver update. This is the kind of shift that rewires the entire game while most people are still arguing about yesterday's candle on a chart. If you're only watching the paper price, you're watching the wrong screen. Yes, you'll see silver hovering around the low to mid 90s depending on where you look. Yes, you'll hear chatter about east-west spreads and premiums, but that's not the story. Here's the story. A new buyer has stepped onto the field, and this buyer doesn't negotiate, doesn't flinch, and doesn't care about your trend lines. This buyer has one mission: secure metal, period. And once you understand who it is and what they've just been authorized to do, you'll realize why the next phase of this market is not going to be volatile. It's going to be structural. Now, quickly, before we go deeper, my YouTube stats show a huge chunk of you watch these videos and you're not subscribed. If you value this kind of breakdown, hit subscribe right now and drop OG John AG in the comments so I know you're part of the real community. Also, check the description after this video because I've left bonus links for you there, including the premium WhatsApp channel link and the channel membership link. Those are there for a reason, and we'll circle back to why they matter. All right, let's talk about the new whale. For years, everyone tried to name the biggest buyer in silver. People pointed at banks. People pointed at certain countries. People pointed at industrial giants. People pointed at retail waves. And the truth is, all of those players mattered, until now. Because as of today, we have confirmation of a major shift buried in official language that most people will never read, and most media outlets will never highlight properly. There is now an approved acquisition program, $2.5 billion, specifically aimed at critical minerals for strategic stockpiles. And sitting near the very top of that target list is silver. Read that again slowly. $2.5 billion, aimed at physical acquisition, tied to national strategy. And I know what some people will say, because I can hear it already. John, 2.5 billion is nothing. They spend that before lunch. And yes, compared to the national budget, it sounds small. But compared to the real physical silver market, especially the deliverable, accessible, good delivery supply, that number is not small. It's a wrecking ball. Here's why. When normal buyers enter a market, funds, traders, even corporations, they tend to be price sensitive. They slow down when price spikes. They delay orders. They hedge. They stagger purchases. They don't want to be the one buying the top. But when the buyer is tied to national security, the concept of the top changes. If an agency decides silver is needed for systems that must function, then the budget isn't a suggestion. It's the starting point. If the first allocation doesn't get the job done, you don't cancel the mission. You expand the program. This is the psychological pivot people keep underestimating. We're moving from silver as a trade to silver as a requirement. That's a different market, because when something becomes a requirement, the buyer doesn't ask, is it cheap? They ask, can I get it? And those two questions lead to completely different outcomes. Now ask yourself something uncomfortable. Why would this happen now? Why January 2026? Why not 2 years ago? Why not later? Because shortages don't announce themselves with fireworks. They announce themselves with small failures, weird distortions, sudden rule changes, and quiet emergency language that only becomes obvious in hindsight. And the people writing these policies have access to data that most retail investors never see clearly. They see supply chain fragility. They see dependency on imports. They see vulnerabilities in sourcing, refining, and transport. They see the geopolitical map lighting up like a warning panel. And they're not making decisions based on what you hope happens. They're making decisions based on what they're afraid could happen. If you rely on imported metal, and global tension is climbing, and industrial demand is already tight, you don't wait for a crisis to hit. You move before the shelves go empty. So here's the nightmare scenario that's forming. This new $2.5 billion program doesn't enter a calm, liquid market. It enters a market already strained, already distorted, already split between paper pricing and physical reality. And that's where we need to talk about the machinery that pretends this market is fine. The futures exchange. Because a lot of people are still treating the futures market like a normal price discovery engine, like it's an honest scoreboard. But that only works when delivery pressure is low and everyone agrees to play the paper game. When delivery pressure rises, especially in the wrong months, the system starts showing you what it really is. A leveraged promise machine that depends on most people never asking for the underlying asset. So let's talk about that pressure. January is not supposed to be the month where physical demand screams. Traditionally, it's more like a hallway between bigger delivery months. You might see activity, sure, but it's not supposed to look like a bank run. And yet, the delivery numbers coming through are not normal activity. They're something is wrong activity. What matters isn't only the headline total, though the total is massive. What matters is the pattern, consistent, heavy requests for metal in a month that usually doesn't attract this kind of urgency. That is the kind of behavior you see when participants are no longer confident they'll be able to source metal later. Then you zoom in one level deeper and you ask, who is taking the metal? Because the delivery reports aren't just totals, they're fingerprints. They show you which desks are handing metal out and which desks are taking it in. And the pattern is not subtle. You see one side consistently absorbing. You see another side repeatedly forced to issue. And when you see that dynamic, you're not watching a balanced market, you're watching a scramble. Now, I'm going to say something that will make some people uncomfortable. When large entities start acting like they want metal now, it's usually because they suspect the rules could change later. It's the same behavior you see before rationing. It's the same behavior you see before cash settlement becomes a solution. It's the same behavior you see before force majeure language stops being theoretical. And that brings us to the most important concept you need to understand: the difference between inventory and deliverable inventory. People love throwing around big numbers. There are hundreds of millions of ounces here, billions of ounces there. Fine. But how much of that is actually available for delivery against futures obligations at current terms? That's the bottleneck. That's where the stress shows up first. And when that deliverable category shrinks while delivery requests grow, you don't get a gentle adjustment. You get a cliff. Because at a certain point, the exchange faces a choice: deliver metal that isn't there, or change the rules of the game to protect the system. Now, most casual investors hear that and think, they can't do that. But the truth is, the ability to settle in cash, delay delivery, alter margin requirements, change position limits, those tools exist because the system was designed to survive stress, not to guarantee you metal. And if you want to know how this ends, you don't start with opinions. You start with arithmetic. If deliverable inventory is X and monthly drawdown is Y, then the question becomes, how many cycles until the shelf is effectively empty? And effectively empty doesn't mean literally 0 bars in a building. It means the remaining bars belong to holders who won't part with them at the official price. It means the supply that can be mobilized at current pricing terms vanishes. That's when the paper price becomes a reference number and the physical market becomes its own reality. And this is why April is being whispered about more and more. Not because April is magical, but because delivery calendars collide with shrinking availability. Here's the setup. You have heavy draw in a month that's not supposed to be heavy. You have a major delivery month coming. You have a new government-linked buyer authorized to buy strategic quantities. You have industrial demand that doesn't pause because it's tied to production. And you have a spread between regions that creates pure incentive to move metal out of one place and into another. That combination is what turns tight into broken. Now we need to talk about the East, because this is where the story becomes impossible to ignore. If you've been watching the pricing differences between Western paper markets and Eastern physical markets, you've probably seen it. Premiums that refuse to disappear. Spreads that don't close like they should. Moments where it feels like two separate universes are trading the same metal. And that's basically what's happening. In a healthy market, arbitrage closes gaps. If silver is cheaper in one region, traders buy there and sell where it's higher, and the gap collapses. But that assumes metal can move freely, quickly, and in sufficient quantity. It assumes there aren't constraints. It assumes there aren't hidden bottlenecks. It assumes liquidity is real. When those assumptions break, the gap becomes a signal of stress, not an opportunity. Because the gap isn't closing if the metal can't move fast enough, or if the metal is already spoken for, or if the higher-priced market is outbidding everyone because the metal is required. Now you add something else: rule changes. When exchanges and regulators start cutting position limits, tightening rules, or issuing emergency adjustments, the normal expectation is that cools the market. But in a stressed market, rule tightening can do the opposite. It can confirm fear. It can scream, "We're trying to slow buying because we see what's coming." And when participants interpret that as confirmation, they don't calm down, they accelerate. That's why you can see a crackdown and then see price move higher anyway. Because demand isn't just speculative. It's fear-based, necessity-based, and forward-looking. And as those higher prices persist, the incentive becomes brutal. If you can acquire metal cheap in one place and sell it higher elsewhere, the entire system becomes a vacuum that sucks metal toward the premium. That's how you drain vaults without needing a conspiracy. You drain vaults with profit motive. And if you think the vaults can resist that indefinitely, ask yourself, how long can a discount store remain stocked when the whole world knows it's a discount store? It can't. It gets cleaned out. And now the US government, of all entities, has stepped into the middle of that dynamic and essentially said, we're buying too. So you have the vacuum, and then you add a giant industrial vacuum on top of it. That's why calling this bullish is too small. This is the kind of thing that changes the definition of the market. Now, let's bring this down to street level because this isn't only happening in institutional reports and exchange data. It's showing up where regular people actually touch the metal, the retail supply chain. And I need you to understand this clearly. When retail begins rationing, it's not because dealers want to be mean. It's because the pipeline behind them is failing. A major U.S. online bullion dealer, one of the biggest in the country, has reportedly been hit with demand multiples above normal. Not busy, not strong week. I'm talking about historic levels. At the same time, internal issues at a private mint supplier, call it mechanical problems, production disruption, feedstock delays, whatever label you want, have reduced output drastically. So you get the perfect pinch. Demand spikes while production capacity drops. And what happens next is predictable. Order minimums get raised, smaller buyers get deprioritized, popular products vanish, shipping times stretch, and in stock becomes a temporary illusion. This is how the market tells you the truth. The chart can lie, the website banner can lie, the premium can hide what's happening. But when you suddenly need to spend $500 minimum just to place an order, that's not marketing. That's rationing in polite clothing. And here's why that matters. When the small buyer gets locked out, panic doesn't decrease, it increases. Because the small buyer realizes something terrifying. Price doesn't matter if you can't buy at any price. That's when behavior flips from wait for a dip to get what you can while you can. And when that behavior spreads, it feeds itself. Now let me drop a quick creative side note right here. If you also want silver-related success stories, real stories about people who made smart moves and changed their situation, there's a link in the description to a separate channel dedicated to that. Subscribe over there too, because seeing what others did right can sharpen your own decisions fast. All right, back to the main thread, because we have to connect these pieces into the timeline that matters. You've got institutional draw. You've got Eastern premiums. You've got retail rationing. You've got a strategic buyer with an authorized program. Now you place it on the calendar. And this is where people get caught because they assume time will be generous. They assume they can watch for confirmation. They assume they can wait for a pullback. But markets don't give you pullbacks when structural buyers are active and supply is constrained. They give you air pockets and then vertical moves. They give you sudden gaps. They give you weekends where the rules change while you're asleep. And that brings us to the phrase everyone hates hearing, force majeure. Most people treat it like a legal fantasy, like something that happens in textbooks. But in commodities, force majeure is a real escape hatch. It's the clause that says, under extraordinary circumstances, obligations can be altered, delayed, or settled differently. And the moment deliverable supply becomes insufficient relative to delivery demand, the probability of some form of alternative settlement rises. That doesn't always mean an official default announcement with sirens. Sometimes it's quieter. It can be delays, premium cash offers to settle, rule adjustments that make standing for delivery harder, margin changes that force weak hands out, or, in the worst case, a direct cash settlement mandate. And the danger is simple. If you think you own silver because you own a paper claim, you may discover you own a promise to be paid in dollars at the exact moment dollars are losing credibility. That's the trap. It's not that you lose in nominal terms, it's that you lose in real terms. You get cashed out at the paper reference price while the physical market reprices higher. So if you want to know why April keeps coming up, it's because delivery cycles and inventory cycles collide around that window. Heavy draw in January and February sets up a stressed March. And stressed March sets up a system that has to decide how it survives into spring. Now, do I know the exact day something snaps? No. And anybody claiming they know the exact day is selling you certainty they don't have. But I don't need an exact day to recognize a tightening noose. I need the direction of the math, the behavior of the players, and the reaction of the supply chain. And all three are flashing the same message. The system is under stress, and stress is increasing. Now here's where the mainstream narrative tends to fail you. Mainstream voices will look at the paper price and tell you the market is fine. They'll say premiums are temporary. They'll say spreads are just logistics. They'll say the exchange has plenty of inventory. They'll downplay because downplaying keeps people calm, keeps flows stable, and keeps the paper machine functioning. But in real commodity squeezes, the truth doesn't arrive in headlines. It arrives in shortages, rationing, and rule changes. And those are already here. Now, let me ask you two questions because I want you in the comments on this, not just watching quietly. First question, have you personally tried buying physical silver in the last 2 weeks? And if you did, what did you notice about availability and minimum orders? Second question, do you think a government-linked strategic buying program will eventually force a permanent split between paper price and physical price? Drop your answers below. And while you're there, if you've had any success, silver, business, life, anything, share a quick win in the comments. Seriously, if you're doing well, tell people. It raises morale, and it reminds others that smart moves still matter. Now let's talk about what this means for you, in practical terms, without the fluff. One of the biggest mistakes people make is thinking this is a trade. They treat it like they can time every move perfectly. But a market moving towards scarcity isn't primarily a timing game, it's a positioning game. Because the objective shifts from buy low, sell high to secure access before access disappears. And access can disappear even if price looks reasonable on a chart. So when you hear people say, I'm waiting for $85, I want you to think about that like waiting for a discount on life jackets after the ship has already hit the iceberg. If there is a true supply squeeze, you won't be arguing about $10 swings. You'll be arguing about whether the buy button still works. Now, I'm not telling you to panic. Panic is emotional and usually expensive. I'm telling you to get serious. Serious means stop assuming the paper price is the whole truth. Stop assuming inventory numbers are all deliverable. Stop assuming liquidity is guaranteed. Stop assuming governments won't intervene. And start paying attention to the signals that matter. Delivery pressure, spreads, retail availability, and official strategic language. Because that language is the tell. When you see official programs naming critical minerals and allocating real dollars to acquire them, that's not a blog rumor. That's a policy direction. And policy direction is slow until it's sudden. Now, I also want to plug something that matters for the community. We're running a campaign to push back against copycat channels and recycled content that floods the space and buries original work. The simplest way you can support is to subscribe and comment OG John AG so the algorithm knows what to elevate. And again, don't forget the description. Bonus links are there for you, including the premium WhatsApp channel and the membership option. If you want updates that don't always make it into public videos, that's where you'll find them. Now, there's one more layer to this story that people miss, the feedback loop. Once large buyers realize scarcity is real, they accelerate orders. Once producers realize demand is inelastic, they raise premiums. Once retail dealers realize supply is uncertain, they ration and increase minimums. Once the public sees rationing, they rush. Once the rush begins, it spreads through social proof. And once it spreads, it becomes self-fulfilling. That's why early stages look manageable, and then suddenly the market looks like it went insane. It didn't go insane overnight. It tightened quietly until the last bit of slack snapped. Now, does that guarantee straight up forever? No. Markets zigzag. But even zigzags look different when supply is constrained and strategic buyers are present. Pullbacks become shallow, violent, and quickly bought. And the more the public realizes there's a strategic bid under the market, the more pullbacks become opportunities rather than warnings. That's why the entrance of a non-price sensitive buyer changes everything. It changes psychology, it changes behavior. It changes the risk profile of being short. It changes how quickly inventory can disappear. So when you hear $2.5 billion, don't translate that into budget talk. Translate it into ounces that have to be located, refined, moved, and stored. And then ask, from where? Because silver doesn't magically appear. It comes from mines, recycling, and existing stocks. Mines can't scale quickly. Recycling has limits. And existing stocks are exactly what's being fought over. That's why I keep using the word vacuum. The metal has to come from somewhere, and the easiest place to pull it from is the pool of deliverable inventory that already exists, which brings us right back to the delivery math. If you see non-delivery months drawing like delivery months, you're watching abnormal stress. If you see one major desk repeatedly absorbing, you're watching preparation. If you see another major desk repeatedly issuing, you're watching strain. If you see spreads persist, you're watching a market that can't equilibrate. If you see retail rationing, you're watching the pipeline crack. And if you see strategic programs allocate billions to acquire, you're watching policy step onto the scale. That's not a normal bull market story. That's an in-game story. Now I'm going to wrap this with a clear takeaway, because I don't want you leaving with only fear. Fear without clarity is useless. Here's the takeaway. This market is shifting from optional to necessary. And when a market shifts from optional to necessary, shortages don't resolve with patience. They resolve with repricing. Repricing is the market's way of rationing. If there isn't enough supply at $90, the market doesn't politely request more. It finds the price level where demand is forced to slow and supply is encouraged to emerge. And that price level is almost never a small step. It tends to be a jump. So the real question isn't, will silver be volatile? The real question is, at what price does the system regain balance? And if strategic buyers are stepping in, that balancing price may be much higher than most people are psychologically prepared for. Now I want to say this again because it's important. If you're successful, share a short success note in the comments. It could be about buying early, cutting debt, getting a better job, starting a business, anything. People underestimate how much momentum a community can generate just by seeing that smart decisions actually work. And if you want the deeper, more research-heavy updates, we do offer members-only videos. This isn't recycled content. A separate team works behind the scenes to build those deep dives with extra research and tighter updates, specifically for premium members of the John AG family. If you want in, hit the join button or use the membership link in the description. So here's what I want you to do right now. First, subscribe if you haven't. Second, comment OG John AG if you support original content and you want copycats eliminated from the space. Third, check the description for the bonus links, including the premium WhatsApp channel and the membership link. And finally, answer the 2 questions I asked, your buying experience and your view on paper versus physical, because the comments section becomes a real intelligence feed when people actually share what they're seeing. We're entering a phase where information lag becomes expensive. The people who wait for mainstream confirmation will be the last ones paying the highest premiums, if they can even find metal at all. So stay sharp, take care of your people, keep your head clear, and I'll see you in the next one.